Today, we're going inside the institutional playbook. We're going to break down exactly how the pros trade those huge market-moving events. Think Fed meetings, inflation reports, and the big earnings releases that can define a quarter.
But first, let's start with a question that honestly drives a lot of people nuts. You see a headline, it looks amazing for the economy, you pull up your screen, and it's a complete sea of red. So what is going on? Why does good news sometimes feel like terrible news for your portfolio?
And this slide just captures that paradox perfectly, doesn't it? You get a fantastic jobs report, more people working, wages are up, and what happens? Assets fall. Or a company absolutely crushes its earnings estimates, and the stock just gets hammered. This isn't random. It's the market speaking a completely different language.
And that gets us to the market's big secret. The professionals, the institutions that are moving real capital, they are not trading the news that you're reading in the headlines. They're working from an entirely different framework. They're trading expectations. This is what they call event risk, and it's not about whether the news is good or bad in some absolute sense. No, it's all about the gap between what everyone thought was going to happen and what actually happened. That gap, plus how traders were already positioned, is what creates those really explosive, violent moves. So it all boils down to this three-step mantra that basically governs everything. First, what does the market expect? Second, how is everybody positioned? Is everyone already betting on the exact same outcome? And only then, third, do you actually trade the market's reaction to the news?
And this quote just nails the idea. A central bank can cut interest rates, which sounds great, right? But if the market was actually expecting an even bigger cut, then that good news is really a disappointment. It's a negative surprise, and assets are going to sell off. It's all relative. Okay, so how do they actually put this into practice? Let's get into the pre-event playbook, because this is where it all comes together. For institutions, the real work happens in the 72 hours before that news ever even hits the wire.
Look, this isn't gambling. It's a super rigorous, disciplined process. They narrow their focus down to the one number that really matters, say core services inflation inside of a big CPI report. They map out exactly what the consensus view is so they know what would count as a genuine surprise. And maybe most importantly, they check to see if everyone is already crammed onto the same side of the boat before the storm even hit.
This cross-asset check is such a powerful tool they use. They're basically looking for tells, for clues. So if bonds are rallying, the dollar is weak, and stocks are just euphoric, like you see here, that's a massive signal. It tells them the entire market is positioned for one and only one outcome: good, dovish news. And what that means is that the risk is completely skewed for a violent sell-off if that news disappoints in any way.
And that leads to this really critical rule of thumb. When literally everyone is confident about the same outcome, when a trade is crowded, the market has this funny way of punishing that consensus. The most painful move is almost always the one that nobody is positioned for.
All right, so now let's jump to what happens after the number comes out. For most people, this is just pure chaos. But for institutions, this is where the real opportunity actually starts to take shape. This is all about finding clarity in the noise.
Just look at this distinction here. That first move, the first few seconds or minutes, that's all algos, headlines, and pure emotion. It's super volatile, it's noisy, and honestly, it's often wrong. But the second move, well, that's different. That's driven by institutions actually digesting the info, repricing assets based on the new reality, and then acting with real conviction.
Which brings us to another one of their golden rules. The second move pays. The pros often completely ignore or even fade that initial emotional spike. They wait for the dust to settle so they can see what the real new trend is. They do not chase that first candle.
So how do they tell the difference? How do they know what's a real move versus just a fake out? Well, they look to one place for the ultimate signal. They have a saying, rates are the truth. The bond market is always the final judge.
This slide shows you the basic relationship. Think of it like a seesaw. When bond prices go up, interest rates, or yields, go down, and vice versa. So if stocks are just screaming higher on some piece of good news, but bond yields aren't moving, or worse, are actually rising, that is a massive red flag for institutions. It means the bond market, the so-called smart money, it just doesn't believe the story.
And they look even deeper at the shape of the yield curve itself. As you can see here, different shapes tell totally different stories. An inverted curve might be whispering that a recession is coming, while the really steep curve is pointing to future growth.
For an institution, this isn't just data. It's the market's deep, forward-looking story about the entire economy. It helps them confirm if the narrative has truly changed.
So let's bring it all home. Let's summarize the golden rules that come out of this entire institutional playbook. These are the absolute key takeaways. First, and this is huge, you have to remember that major events are fundamentally about repricing the future narrative. A little squiggle on a technical chart just doesn't matter if the entire story about future growth or Fed policy has just been completely rewritten.
Second, always respect the hierarchy of signals. The bond market's message is the one that really matters most. If the bond market doesn't confirm a move in stocks, you have to be very, very suspicious.
And third, that initial chaotic algorithm-driven spike, that's not the signal, that is the noise. The true opportunity often lies in patiently waiting for all that emotion to burn itself out and then trading the more rational, considered move that comes after.
And that just drives home the final, crucial point. The goal isn't to guess the outcome and get lucky in the middle of all the chaos. The real goal is to survive the event, wait for the dust to settle, and then, and only then, deploy your capital with high conviction once the new reality becomes clear.
So I'll leave you with this question. The next time you see a major headline hit the tape, just ask yourself, am I just reacting to the news itself, or am I analyzing the expectations, the positioning, and the market's true reaction? Because shifting your perspective from that first model to the second one, well, that's the entire game.